Hello everyone, a very good morning, good afternoon, and good evening to all. Myself Vaibhav. In our today's session of automated trading, we are starting with the Bill Williams Market Facilitation Index, and here a technical indicator which can help us guide in detection of the trend. So basically, we are working with these two conditions only. This indicator turns out four different combinations of the values, and as you can see, we are not really bothered about the absolute values. And here, even if you simply Google it, it's working. You will get a clear-cut idea, and of those four values, we are working with the two of the combination, which I think can be of really helpful. And these two combinations are that market facilitation index is also up along with the volume, and the market facilitation index is down along with the volume. And what will we can conclude from this combination is that when the MFI is going up and the volume is going up, that means that the price and the volumes are in tandem, and the increasing volume is pushing the price higher. And in case the momentum is down and also the volume is going down, that means the market participants are losing interest, and thus there is a possibility of a reversal happening. So we will be getting this combination along with the price action. So that's the title, the BWMFI with the price action. And ATR, one of our favorite indicator. It is going to help us pinpoint the entry and the exit points, and also facilitate the volatility prevalent in the market. Before we go into the detail, there is a standard disclaimer. Here I would like to remind you that this session is simply for the tutorial purpose, and no claim is being made regarding the profitability or otherwise of the algorithms which we will be developing during the session. Suppose if you want to use any of it, I would recommend that you do extensive trial runs and also allow it to run on the demo account for sufficient enough time to get a clear idea of the efficiency of the said algorithm. And of course, nothing in the webinar is to be constructed as an advice to trade or for any particular setup. With that, we turn our attention to the charts. Here I would try to explain to you the basic idea behind today's setup. So here on the BWMFI index, we will be on a search for a particular combination when these two bars, one is the green bar is preceded by a brown bar. So the brown bar stands for when the MFI is down and the volume is down, and green bar stands for when the MFI is up and the volume is up. We are not really concerned about the absolute values of these both these combinations. We are going to simply look at the condition when this combination is simply showing above zero values, and the rest of the three outputs are zero. Of all these four outputs, at a time only one output is above zero, and all the other three outputs are equal to zero. So whenever the combination will repeat, suppose if the last candle has closed with MFI up and the volume up combination, so we go back and look at the combination at previous candle, and if it is showing that the MFI is down and the volume is down, we will then look at the price action for last 2 hours. So the prior candle, suppose if it has closed with gains, then we look at the prior candle and it should have closed with losses. That means that the market participants were losing interest in the selling, and now with increasing force the buying is happening. And to make sure that there is decent volatility, we will be also looking at the ATR values, and the last 14 hours ATR we will be taking, and then we will compare the closing and for the closing and the opening also. And before that we will be taking a look on the high and the low, and we will want to ensure that The difference between high and low is greater than the ATR for the hourly time frame, and then it should have closed with gains which are more than 50 percentage of the ATR value. And suppose if it has closed with losses, that is the closing price is lower than the opening price, then we will be looking for the sale trade, and the prior candle should have closed with gains. That means the prior candle was in green and then it came in red the next candle. So that will be the bare bone structure of our algorithm. So we are not utilizing any other technical indicator for the timing. Maybe once we are done with this setup, maybe in next couple of sessions we might even try a different combination. But let us focus on the price action, and I hope that it should work well, and only the test runs will tell us if we are getting the combination right and if it is working as per our requirements or not. So till we build it fully and then we test it, we can't really be sure. So let's get to the work on the Visual JForest platform. Here we will build the algorithms from the scratch. Here is the first session, so we don't have anything here. Now we will need to look for the components. First thing first, we are going to do the candle, the instrument subscription, and then the position amount. So we at a go we will need 3 blocks, and as usual most of the time we work with the on tick as a start point. Today is not an exception, we are working with on tick only. So now we do the candle sorry, not candle, we do instrument subscription. Default variable, default instrument, it should match the tick instrument, and the tick instrument should match the Euro USD. So we will put in this value of Euro. We will need to search for Euro USD here, and we got it at the first go, fortunately. No waste of time. Now position amount will need to be defined at 0. We go for position info, all positions, both pending open and the open current open position, it should be 0. We just want to make sure that our algorithm is not accumulating too much risk, and that's the only reason why we want to make sure that there is no current open position on the account. You can even omit this condition if you feel like. Now let us get to the indicator section. Here we will need to look at the Bill Williams part, and it was developed by the Bill Williams, so it is called BWMFI. It is the Market Facilitation Index. Let me color code it, so we will be aware of the flow that it is going through. We are going to need 2 blocks, shift 1 and shift 2. So we will be looking at the prior candle, the last candle, and the penultimate candle. Default instrument Euro USD, okay, and we shift, we change this to 1 hour. So 1 hour hourly, okay. This one also will need to be converted to hourly, and we do the shift 1. Here we change it to 2. Now, as I was explaining to you, we get four output values, and for our algorithm, we are not really concerned with all the four values. We are basically concerned with only two. That is MFI up, volume up, MFI down, volume down. That's all we are looking for. We are not really taking into account these other two combinations, MFI up, volume down, and MFI down, volume up. Now we are also going to need to take two historical candles. So we go for the info part. In info, here we have single get historical candle. We will need two, shift one, shift two. That is last hour and hour prior to that. So we bring it here. We will now do the conversion. Conversion means we will simply define the parameter as per our requirement. Here we have done that, and I hope these values are on the bit side, the closing level. Okay, no issues. Now output values, candle 17, candle 18. We connect the flow and we do some changes. It should be 1 hour. And hourly, all right, we do again the change, shift should be 1 and this one should be 2. 10 minutes needs to be converted to 1 hour hourly. So we convert it, done. And now we also need the ATR. As you are aware, we utilize it for defining the volatility, and it is part of, I guess, other. Yes, this time around we got our guess right, so we bring in the ATR and again we do the changes. Here it will also be hourly. Default instrument, candle time frame, and we do it to 1 hour. All right. Shift will be 1. So it will take into account the last hour's ATR value. Then comes the output value. So far so good. We have brought in these three major components of our algorithm. Now let us go back on chart. What we need to do to define our parameters. We will first look for an example where we can think that the conditions for our trade execution might have been fulfilled. So let us go back here. We need the green candle follow after the brown candle. So here this is the combination, and then we take a look. The time is 12 GMT on the 5th of March. So we have this. So after this hourly candle closed with decent gains, our algorithm would have started looking for the buy trade since it has closed with gains, and the closing price and the opening price. I think the difference between these two prices is also more than 50% of the ATR. The ATR was around 18 pips, so we need a difference of 9 pips between the open and the closing price. It has gained more than 50% of the hourly ATR, and also here you can look for the difference between the high and the low, and this is also more than 18 pips, so it is going to satisfy our requirements. and then the prior candle has closed with losses, and that means that the momentum is starting to shift on the buy side, and the short sellers are not that interested in the ongoing momentum on the sell side, and we might see the shifting of the trend from being bearish to bullish, and that is what happens in the next task. But of course, every time it is not really going to happen. So now let us again go back in time and look for a sell trade, and this is around 0 GMT of the 4th of May. So here we get, okay, so here again the ATR is of around 15 pips, and 15 pips, okay, it is closing lower by more than 50 percentage of the ATR, but we will need to also compare its opening and the close, high and the low difference, and hopefully it seems like that the difference is also higher than the ATR of the hourly time frame, and then the prior candle has closed with gain. So here we can indeed go for a sell trade, but of course we will need to do the testing. But I'm explaining to you the requirements for our algorithm. So here, now the question is whether to go for a market open or whether to go for a pending open. Then if you are going for a pending open, whether to go for a limit order or whether to go for a stop order. So all these different combinations can be tried on, and for our session we are simply going to stick with the market open. Maybe if suppose if you want to use pending open with your stop or limit order, you can prefer you can if you prefer to do that, if you want to work with pending open order, then I think you can even utilize our earlier setups in which we have done pending open for many positions. So you can utilize that guidance as well. And let's again go back on the chart, not on the chart, on the trading platform, and here we are back and we start to work with the buy side first and then the sell side. So now we need to do a bit of calculations, and for that we are going to need the mathematical calculation expressions. And here we have, oh, the fly is troubling me. Here comes the calculation expression. So we look at the last candle's high and low, and then its opening and the closing price. We take candle 17's high, fly, okay. We go to the auto created section. We have candle 17. We take its high price, and we deduct the low price. So we want to do a1 minus a2, and the result will be high low difference, HLD. Alright, we got it. So we keep it somewhere here. We join the flow. And then comes now we take the close and the open difference, and here a1 minus a2, and it will be by difference, and then we will compare this to the 50% of the ATR, so we will need to do that calculation as well. Suppose if it is going down, then we will need to do a different set of calculation. We will need to deduct the closing price from the opening price, as the closing price will be lower than the opening price when the value of the underlying instrument is going down. Then at such instances we want to deduct the closing level from the opening level. So we first take candle open, and then we deduct candle close, and we again do a1 minus a2, and then we define this as selling difference. Okay, now we need to do the calculations for the ATR. We are going to need to define the 50% of the ATR. For the 100% of the ATR, we can simply take this line 19 value and then compare the high and the low. For 50%, we bring in another calculation expression, and we take this output line 19. We create a fresh variable of type double. Alright, and it will be 50% of the ATR FA. The value would be 0.5, and then we take this and we multiply it a1 into a2, and the result of the calculation will be 50% of the ATR, that means FAT. Alright, so far so good. Now 50% of the ATR done. We will also need 10 seconds time frames historical candles, as we want to set a trigger point. We will need a trigger point, the precise levels at which the order will be placed, and for that we will need to rely on the 10 seconds historical candle data. So we go to the info part, and we bring in historical candle. Okay, so here we have got this, and it needs to be defined at 10 seconds. It will be shift 1, then comes the second. Here also again 10 seconds. It will be shift 2. Okay, so we need to join the plot here. Now, as you can see, we have done a lot of calculations. One thing is that we will need to define the stop loss and the target level. For that, we will need to do additional calculations. So let us see what can be the optimum target price and the stop loss price. I think we can basically work with the ATR on the hourly time frame, and we can simply define it in simple percentage terms, like the 100% of the ATR, and then the target can be twice. So we will conservatively we will get a risk reward ratio of 1:2. So uh, in such instance, we need to take in the calculation expressions again info logical mathematical, and we need two of these. So here we will need to define the ATR range. So we first we take hourly ATR. Okay, so line 19 and line 19. It will be simply multiplied by the four zeros on one, that is for 10,000, to do the type conversion from double. This ATR value is in the double format, and we want to convert it in the integer type. So we will do like TP, and it will be 2, and then we create another variable that will be the execution pips, and it will be So let me see. Yes, it is right. Now we need to double it. So we need to create one more variable, and it will be by execution pips, and it will be twice. So here we go. And then comes the A1, oh, into A2, into A3, and it will be by stop loss. And here A1 into A2, and the execution pips 10,000, and here it will be, no, here I think we have done it wrong. This variable is going to be the twice of the ATR. It means it will be used as a target by target price BTP. Yes, and the buy stop loss is going to be this. Okay, so now we are also running out of time, so for the day we stop here, and then tomorrow we again get back and continue to work with our algorithm. Till then, have an excellent time ahead. See you tomorrow, guys. Goodbye.